Hello and welcome back to my channel. Today I'm going to be looking at conventional mortgages. So before I begin, please consider liking and subscribing, and let's get right into it. So conventional mortgage, what is a conventional mortgage? Conventional mortgage is a mortgage that is not insured or guaranteed by the government. Now, I came across these two articles. The first one that I'm reading from is from Business Insider. I figured I'd cover it because it goes into good detail of what conventional mortgage is. Now, government-backed loans are like FHA, VA, USDA. Those ones, I already covered them. The videos should be somewhere. I'm gonna link the videos once I'm done. You can click and go watch them if you want to find out more. But a conventional mortgage basically is a mortgage that isn't insured or guaranteed by the government. So the types of conventional mortgage is depends on, there are two types. Either there's a conventional conforming mortgage or conventional non-conforming mortgage. What's the difference? The difference is conforming mortgage has a county limit, like it conforms to a loan limit. There's a limit that you cannot exceed. If it gets to, let's say, in a certain county, you cannot get more than, for example, 700,000 mortgage. So that is a conforming mortgage. Now, non-conforming mortgage, that one you can exceed the limit, and those ones, there are different types. They're like jumbo loans. Then there's other ones that I don't know if other lenders provide it, but there are several types like access loans, jumbo loans. Those are non-conforming. In the mortgage industry, they call them non-QM loans. So that's the difference. Conforming has a limit, non-conforming, no limit. Now, who qualifies for this? Let me go to this other article to see the qualification, the loan requirements, the credit score. At the time of recording, we're saying the minimum credit score is like 620. However, these credit score requirements always change all the time. So at the time of recording, that was the credit score, but the higher the credit score, as usual, the better you're gonna be getting in terms of rates and everything. So higher score, much better. Your debt to income ratio, DTI, your DTI, most lenders don't want to exceed 50%. So what in the world is a DTI? Going back to this, okay, credit score, they already covered the 620. Debt to income ratio is the amount you pay towards your debts each month divided by your gross monthly income. For example, they gave a good example here. For example, if you spend $2,000 per month on your mortgage, student loan payments, and you earn $3,000 per month, your DTI ratio is 2,000 divided by the 3,000. It's like the debts you have. Let's say you're paying $1,500, to make the math easier, $1,500, but you earn 3,000 per month. DTI is gonna be that divided by your earnings. So in that case, it will be 50%, but in this case, 2,000, 3,000 is around 66%. That's the DTI ratio that the underwriters use to determine if you're going to be qualifying or approved for this type of loan. Now, the DTI can be as high as 50%. Let's skip back, but for most times, it's going to be harder for you the higher the DTI, because that means you have more debts and you might have a problem making the monthly payments. Now, down payment amount, minimum down payment is around 3%, and some lenders require 5, 10%. However, if you put down 20% or more, you can skip the mortgage insurance, because conventional mortgages do have mortgage insurance, private mortgage insurance. This one you can pay them monthly, like borrower paid monthly premiums, so you can pay them like full premium at once. Most people do borrower paid monthly premiums. So if you put down 20% or more, you can skip the mortgage insurance. So, okay, so let's go back to this. This other article is from Bankrate. The down payment 20%. We've covered that. Private mortgage insurance PMI. If you put down less than 20%, you'll have to pay the PMI. Okay, the loan size, that's the conforming and non-conforming that I was talking about. Okay, so this one is going more into detail that what the conforming really entails. The jumbo loans, those are like non-conforming. Okay, so non-QM loans are more risky. I remember, like here it states it actually. In the 2008 financial crisis, it is this type of loans, the non-QM, that really messed people up properly in the 2008 crash. Okay, so back to this Business Insider. So these are the economy, depends on the mortgage. I mean, it affects the mortgage rates. Obviously, economy, high interest rates, it's going to affect the interest rates you're going to get. And also, many people won't want to probably be buying their homes at high interest rates. Where you live also affects it, because, if you live in the city, most of the times you will be subject to higher interest rates compared to somebody in the rural areas. Also, you're going to be subject to higher property costs. It's going to cost more in the city than the rural areas. Personal finances, that's the DTI, that debt to income ratio that we already looked at. Now, the other thing is the term of the loan. Now, we have fixed rate mortgage. This one locks you in a rates for the entire life of the loan. Most people take like the 30-year mortgage, but with this, some can adjust it. Some can take 15 years. And then there's an adjustable rate mortgage, or ARM. This basically means it can stay the same. ARM product, that's what we call it in the industry, ARM products. So this one, if let's say you have five, they have a good example down here. Let me see if I can find it. Oh yeah, if you have a 5-1 ARM, this is a common type of adjustable rates. That means that for the first 5 years of the mortgage, your rates will stay the same, and then it will change after the 5th year, and it will change once every year. So that's the 5-1. That's what it means. 7-1 is the same, like it stays the same for the 7 years, and then it changes every year. That's also same for the 10-1 ARM product. Now those are the adjustable rates in conventional. So points is basically when you're like locking the loan. You're gonna be, if you want to lower your rate, you might be charged higher points. But this one, your broker will explain this to you, or your lender, because for most people these are foreign stuff, unless you're working like the law. If you know a lot about locking interest rates for mortgages, it's quite complicated sometimes, because there are some tests you have to pass so that you don't fail like compliance. But anyway, let's skip that because that's gonna be more complicated. But I just wanted to cover conventional mortgages in general for the first, you know, very very lightly, just to show you the types, back to the basics, like the conforming, those ones, and then non-conforming. You remember conventional conforming, they have like a limit, a county limit. Non-conforming, those ones you can go over the limit. Then there's a fixed rate, conventional, and then there's adjustable rate. Those ones you can adjust, maybe 5/1 so that's 5 years, same rate, and then it changes every year. And then if you put down 20% or more, you can skip the mortgage insurance. And also, what else? That's really, the higher credit score, the better the interest rate you're gonna get. So conventional conforming, if anything to take home, the last word is conventional conforming. That it is not government backed. It is not backed by the US government. It's not guaranteed or insured. And it's available in fixed, adjustable, conforming, jumbo, non-QM loans, non-qualifying loans. So that's really it for now. So if you like the video or you found some knowledge in it, please consider leaving a like, consider subscribing, and I will see you on the next one.